Hello and welcome to Portfolio Matters. And we have an exciting day today because we have our first investor interview, and William Konarzewski will be talking through his worst trade in Slack Technologies. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. So, William, would you like to tell us about your trade in Slack Technologies?
Yes, well, first of all, thank you very much for inviting me, Richard and Keith, and thank you very much to anyone who's listening. My worst trade ever, which was about just over a year ago, was a short spread bet on Slack Technologies. And one of the ways that we present this is to look at the two or three of the key learnings. And just to focus mine, I'm going to say one of my learning points is do not go short in a bull market. Secondly, beware of stocks that are already heavily shorted. Very briefly, Slack Technologies is a US technology firm very comparable to Microsoft Teams. It's designed for big companies, employees to communicate with each other, have video meetings and send messages. Now, why did I go short on Slack Technologies? I think the first reason is that the fundamentals were pretty awful. I don't know if anyone's familiar with Stockopedia rankings, but basically it's a facility for investors, and a score of 0 is very, very bad. A score of 100 is incredibly good. And Slack Technologies had a score of 2 out of 100. So it was really on the bad end of fundamentals. And it reminded me very strongly of some of the dot-com technology firms that were very overpriced in about 2000. They weren't making a profit. They were all about dreams. People were spending a lot of money on them, and then the whole bubble burst. And I thought that Slack Technologies was going to be just like one of those. And I did a little bit of research, and it was basically Microsoft wanted to buy up Slack. Slack said no. So Microsoft said, well, in that case, we're going to just compete with you and see who wins. And it was pretty obvious that they thought that they were going to win. I thought that Microsoft were going to win too. And then the other thing that influenced me was that there was a short interest of 10%, which is quite a lot. 10% of smart investors were buying and selling these shares with a hope that they would go down and that they would make a quick buck. And I thought, well, I'm going to join that club. The loss making was something that I would have found very worried as an investor. Their losses quadrupled in the year before I bought them, from 2019 to 2020, and they lost $571 million. What I did not look at with the attention that I probably should have done was that they did actually have very large cash reserves of about $841 million. They were a long way from being bankrupt. They had absolutely no debt. And although the book value was negative at one point, it very quickly became positive. But I just saw what I wanted to see. I saw all the negatives. Now, I'm going to go into the diary or the anatomy of the actual trade. You should be able to see it on the slide. I've been watching it going downhill, and from about $23 to around about 1960 on the 28th of January, which is when I bought it. I stuck in a stop loss at 30%. I wasn't expecting to lose this trade. It was just 30% to cover a worst case scenario. Anyway, the first thing that happened a couple of days later was that Yahoo got interested in using Slack technologies. They acquired 130,000 new paying users. The shares jumped 15%. Well, in that case, a lot of people would have sold quickly and got out, but I thought, no, this is just irrational exuberance, maybe. Anyway, a few days later, the share price went up to $26.50. I got stopped out. I lost 30% basically in 10 days. In fact, I probably lost 32% to allow for the slippage. So I'm going to look at some of the lessons. I'm probably not the best person to talk about stop losses, but basically what I would say is do not use a fixed percentage like 10% or 8% or 10, 12 or whatever you normally do or you might do. Calculate it mathematically by whatever technique. And if you find that your trade probably needs more than 7 to 10% as a stop loss, then just don't take it. Wait till the risk-reward ratio is a bit more in your favor. The other thing as a UK investor is that one has to realize, or I had to realize, that the US market is actually very different from the UK market. On the positive side, the UK market over the last 100 years gives you about 2%, 2.5% more than the UK market. It's also a very liquid market, which is a good thing in many ways. The Americans don't really believe in commissions. They have very small spreads, around about 0.1% or lower than that even. There's no stamp duty, and they can buy and sell shares very quickly and very easily on some very efficient exchanges. One of the things that the British investor has to be aware about is quarterly earnings. In the UK, we have annual earnings, half annual earnings. In America, by statute, they have to have quarterly earnings. And American investors don't like to be disappointed. And if they're disappointed, they will knock 20 to 30% off the price of a share overnight. Conversely, if they like what they see, the share price can shoot up 10, 20, 30%. The Americans view fundamentals slightly differently from us. They're not all Warren Buffetts. They like a good story, and they're very often prepared to overlook a few debts, a few years of annual loss, providing the story is good. And if as a UK investor you don't realise that, you can make mistakes, just like I did. This applies more to small shares or small companies rather than big companies, but it's worth knowing. I'll make a brief word here about slippage. I'm sure the majority of people are aware of what slippage is. Basically, if there's a gap up or a gap down, your stop loss won't necessarily cover you. And it's worth considering, certainly if you're spread betting, which is how I do most of my trading, is using a guaranteed stop loss. Okay, it costs 1 or 2% more when it's triggered. On the other hand, if it's going to save you a 20% loss, that's probably pretty good value for money. So I'm going to come to the end now and just summarize the key learnings. Number one, don't go short in a bull market unless you really, really know what you're doing. If you're an amateur like me, don't even think about it. Bad shares go up as quickly as good shares in bull markets, and you will be caught out. And you only have to think of GameStop and Tesla to realize that if you're in a bull market, good things happen to bad shares. Number two, and this is the strangest one really, avoid heavily shorted stocks. Again, you only have to think of GameStop and Tesla. For some reason, statistically, they do better, and they have done for the last few years. Heavily shorted stocks will do better in the sense of going up in value than unshorted stocks. I've no idea why that is. Maybe some kind of reverse psychology. Number three, okay, well, we all use technical and fundamental analysis, or I hope we do, but you've got to understand what you're doing. And I was using it, but to be honest, I wasn't actually understanding what I was doing. I saw the fundamentals. and I didn't realize what the significance of them was, especially not in the American markets. Number 4, research your asset. I'd done a bit of research. I knew it was competing with Microsoft Teams. I knew it was heavily shorted. That's great. What I did not know was it was a very, very well-loved stock. People absolutely loved it. And that was much more important than the fact it was in competition with Microsoft. And finally, just another word about clinical stop losses. I now don't want to take much more than a 10% loss on any trade. I work out what the stop loss should be. I often don't use stop losses, but if I do, I make sure that it doesn't have to be more than 10%, because if it does, your risks outweigh the rewards. And that is it. I thank you very much for listening.
Thank you, William. That's very interesting. And Rich and I both have questions. I'll go first if you don't mind, Richard. But I don't think you did that much wrong. I mean, I think your thesis was fundamentally sound. And to me, I mean, the basic problem was trying to short a technology stock in a bull market, which frankly is not going to end well. But the thing is, when you talk about stop loss, the stop loss both worked and didn't work in this case, in that, you know, as you say, it kicked in, which prevented further losses. But actually, this was a very volatile stock. And if you had been able to fund the position, you would have actually been able to get out at a profit a couple of months later, although you would have had to be quite fast in taking that profit. And later in the year, I noticed that the Slack share price really went very high. So the question is, well, first of all, was the trade was kind of misguided in selling a technology stock during a bull market. But the other thing is, ultimately, I think you're going to be right on this company. So if you had sized it smaller, could you just have lived with it and let it run until the trade came good?
That's a very good question. What I actually did was I had Microsoft as the opposite thing. So I was invested positively or long. I went long on Microsoft for the same amount as I went short on Slack.
Yeah.
Unfortunately, there's a COVID crash. And what happens in a crash is that good firms go down as fast as the bad firms. So what happened was I got stopped out of both.
Right.
I had a net loss. I managed to lose money on both companies. So my master plan turned out to be a bit of a disaster.
William, did you have a target in mind when you sold?
No, I actually thought this was going to go bankrupt. I thought I was probably going to make 50, 75% profit on it. Right. And I thought I'd just run it till the inevitable bankruptcy.
And was that before you'd noticed that it had actually quite a lot of cash and it had a runway that was longer than you had anticipated?
Yes, I mean, I think my big problem with this trade was that the whole market was getting wobbly at this time. I took my eye off the ball. I had other trades.
Yeah.
I was really confident that Slack was going to go down. I was selling other stuff, and I think I got a bit distracted.
Yeah. So I understand your long short strategy, and I know quite a lot of people use it as a way of sort of balancing risk. I guess one of the problems with shorting is that the maximum you can gain with a short is 100%. The maximum you can lose with a short is infinity, isn't it?
Well, that's right. And you only have to look at Salesforce. Some people lost multiples of their original stake. You know, it was a few 100% they lost.
Yeah. Mm. Well, on that note, William, I will confess that many years ago now, I did a very similar trade during the financial crisis, in that I noticed Volkswagen shares were holding up and Ford shares were getting hit. I sold short Volkswagen, I bought Ford, and I think everyone knows what happened there. The Volkswagen shares, I mean, frankly, I think the whole thing was a German orchestrated fraud. But Volkswagen shares basically were pentupled and it cost me a lot of money, and it bankrupted a friend of mine. So, I mean, ever since I have been very wary of shorting companies, because I think the risk reward profile is fundamentally against you. And I mean, ultimately, you don't want to take any risks that are going to seriously damage your wealth. And in the case of, say, Volkswagen, I had a very small position, and it was quite painful, my losses, actually. So the other thing I wanted to talk to you about was how do you manage the stresses of spread betting? Because I find that it changes my psychology. Seeing the P&L like tick up and down live by pounds and pence. Whereas I know you do a lot of spread betting. I mean, how do you talk us through how you manage that, the stresses?
I mean, there's a 2-hour answer to that question and a 2-minute one. I think it's actually, it's all about self-discipline and money management. And the funny thing, well, I've been making a lot of money over the last 4 months. Everyone has, because the markets I've only gone long. I'm probably never going to go short again. And when you're making money, there is no stress. I go in with very small stakes with a philosophy that if I lose everything, and it's never going to be much more than 50% at the very worst, I can handle that. So I don't use stop losses. I just go in with a small stake, and then I start using stop losses as I expand it. So it's low stress. I'm very bad at handling stress. So everyone's got to work out a strategy that works for them personally. And my strategy is basically going in short, writing off small losses, and then upping the stake as they go up. And that's reasonably safe.
And William, would you describe yourself as a short-term trader or a longer-term investor?
Both. I've got my traditional ISAs that are packed with index trackers, things like Microsoft, Apple, Amazon, lots of big solid US companies. And unfortunately, the currency risk is kicking in at the moment. But basically, there's half of me that's long term. My short term, again, my philosophy is only buy stuff that you would put in an ISA, but leverage it up to 5 times. And if you're lucky and you've got a bull market, things will go your way, and you just stop trading when it goes against you.
So when you're trading using your spread betting account, are they usually short-term trades?
It depends. My average is 28 days for a winner. It's about 36 days for a loser. I guess that's short term, but I've got another spread betting account which I'm using as an ISA, where the trades are all built into next September. You can have a fixed rate package, say 1.5% extra, and you keep them for a year. So I do both on spread betting.
So William, you're using spread betting for the leverage or for tax reasons?
Tax. I was well, we've just had a budget today, so that's quite topical. I foresee that the Chancellor is going to look very hard at capital gains tax, and I had too much money outside ISAs, and I thought that this is the time just to completely change my strategy, sell up everything, put everything into spread betting accounts, and hope for the best.
And do you use leverage, the full leverage, or because you don't have to use leverage in a spread betting account, do you?
No, you don't. You can actually have what some people call a spread ISA. So in other words, you work out your nominal value and you have 100% of your nominal value. That is basically stress-free. It's stress-free as a conventional account. A little bit more expensive to run, 0.45% on Hargreaves Lansdown, probably 1.5% annual management on IG. So it's a bit more expensive, but fundamentally it's the same. It's pretty stress-free investing.
But you don't have the temptation to basically overinvest because you don't have access to the leverage?
No, because I handle stress badly. I am a bit leveraged. I've got one account where I'm 50% leveraged. My other accounts are just ordinary, but it's a relatively small account. I'm still learning, so I'm happy with 50% leverage.
Yeah, interesting.
So, William, can I just recap to make sure I understood that properly? Are there accounts where essentially you can organize the trade so that it's a spread bet rather than an investment?
You can do what you like. I mean, it's a wonderfully flexible system. It's taken me about 3 years to get my head around it. And I'll be totally honest, I've lost a lot of money until about 4 months ago when I completely revised my strategy. You can lose a lot of money. And basically, the accounts are the same. It's just the way that you buy your assets. And in some companies, like IG, I've got 3 accounts. I've got my buy and hold account, and then I've got 2 trading accounts, one medium term and then one short term. So it's organized like that.
Very interesting, because as you're absolutely right, if CGT rises significantly, I suspect a lot of us will be following you and trying to organize our portfolios as spread bets rather than investments if they normalize CGT with income tax rates and you face a 45% CGT bill, then nobody's going to invest in the short stock market short term. We'll all be spread betting. So that is very interesting. Thank you.
Yeah. Thank you very much. That was a very interesting discussion. I have occasionally tried to short, and I think I've always failed. And I just don't do it now because I find it's contrary to the way I think. I invest in companies I think are doing well, and I have to sort of totally invert my psychology to short, and it doesn't really work, to be honest, for me.
So to summarize, for me, William, the key takeaways from your presentation were that selling short is very dangerous, but actually I think that having the stop loss was a very good discipline and it saved you. And also I'm very interested in the way you've organized your portfolio so that it's spread bets to avoid CGT. That is something I will go away and look at.
Yeah, I think very, very interesting, William. Thank you very much for sharing it with us. And I think maybe it'll encourage Keith and I to look a little bit further into spread betting and the utility of it, and maybe we'll do something on it in a while.
Yes, absolutely. So I think all that remains is to thank William for sharing his My Worst Trade with us, and I hope if any of our viewers would like to come on and share their experiences for the edification of the rest of us, we'll be very, very happy to host you. So please drop us a line. So thank you, William Konarzewski.
Well, it's been a very, very great pleasure. Thank you. I'm very honoured to be your first guest.
Well, thank you very much.
Thank you, William. So goodbye from William.
And
goodbye.
Goodbye from Richard.
And goodbye from Keith.
Right. Goodbye.
Goodbye.
Cheers.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.